Kevin O'Leary loves to say your $5 lie is the reason you're not a millionaire. That skipping coffee will magically fix your financial life. And for years, people swallowed that advice because it felt responsible. But in 2026, that mindset isn't just wrong, it's dangerous. Here's the uncomfortable truth. Saving pennies in a system that's bleeding purchasing power is a losing strategy. Inflation doesn't care how disciplined you are. You can cut every coffee, every subscription, every small pleasure, and still fall behind. Not because you're lazy, but because you're playing defense in a game that only rewards offense. If you're still broke, it's not the latte, it's the strategy. The world has changed. Money doesn't grow by sitting still anymore. Cash is no longer a safe place. It's a melting ice cube. And the people who keep telling you to just save more are either clueless or already rich enough that inflation doesn't hurt them. Think about it. If saving alone worked, an entire generation wouldn't be working harder than their parents while owning less. Wages wouldn't lag prices, rent wouldn't feel like a chokehold, and young people wouldn't feel like the game is rigged, because in many ways it is. The real divider in 2026 isn't who works the hardest, it's who understands leverage, timing, and capital deployment. It's who knows that the first $100 matters more than the next. $10,000 because that first move determines your trajectory. Most people never get rich, not because they lack money, but because they don't know what to do with small amounts. They wait. They overthink. They tell themselves they'll start when they have more. And by the time they do, the opportunity is gone. Meanwhile, others are quietly positioning. They're not chasing hype. They're not gambling. They're learning where capital flows before the headlines catch up. They're using small amounts of money as tools, not trophies. This year is not about cutting expenses until your life is miserable. It's about understanding where value is being created and getting there early. It's about turning $100 into information, positioning, and a momentum. Because wealth doesn't start with millions. It starts with clarity. And once you understand that, the lie was never the problem. Kevin O'Leary's advice sounds smart because it's simple. Don't spend, cut the coffee, save every dollar. But here's the part no one says out loud. He's giving that advice from the top of the mountain, not the bottom. He's a multimillionaire. His money already works for him. Yours doesn't. That difference matters more than people realize. When someone with millions tells you to stop spending, they're talking about protecting capital. When someone with $100 follows the same advice, they're freezing capital. Those are not the same game. One is defense. The other is slow financial suffocation. Celebrity money advice is dangerous because it ignores starting position. A billionaire can sit in cash, collect yield, wait out cycles, and still win. You can't. If you just save your $100 in a jar, inflation will quietly chew through it. By December 2026, that money buys less food, less time, and fewer opportunities than it does today. That's not discipline. That's decay. This is where the real mistake happens. Don't spend sounds responsible, but it creates a scarcity mindset. You start seeing money as something to hoard instead of something to deploy. You obsess over tiny expenses while ignoring the massive risk of doing nothing. You feel productive because you're cutting costs, but your net worth doesn't move. Being cheap is not an investment strategy. The rich don't win by saving harder. They win by multiplying. They use money as a tool to access skills, information, assets, and leverage. They understand that a small amount of money placed correctly can change trajectory, while a small amount of money sitting idle slowly dies. And here's the irony. The people screaming stop spending are often the same. People investing aggressively behind the scenes. They don't avoid spending, they avoid wasting. There's a difference. Spending on liabilities keeps you stuck. Spending on assets, education, positioning, and asymmetric opportunities is how money grows. If saving alone worked, inflation wouldn't be the silent tax destroying the middle class. If saving alone worked, cash wouldn't lose value every single year. But it does because the system is designed that way. So when you hear celebrity advice telling you to just cut expenses and wait, understand what's really being said: play safe in a game that punishes safety. You don't need to be reckless, but you do need to move, because money that isn't working is money that's disappearing. Here's the brutal truth. No one likes to hear. You're not poor because you don't earn enough. You're poor because of how you think about the first $100 that touches your hands. That sounds offensive good, because nothing changes without discomfort. Look at the difference between how poor and rich decisions are made. Not in theory, in reality. A poor mindset takes $100 and asks, what can I buy right now that makes me feel good? So it goes to shoes, gadgets, clothes, status symbols, fast dopamine, zero return. 2 years later, that $100 purchase is worth $10 if you're lucky. Most of the time, it's worth nothing. A rich mindset looks at the same $100 and asks a complete different question. How can this come back to me with friends? Not enjoyment, not comfort, multiplication. That's the gap. And it's not income, it's thinking. Poor people spend money once. Rich people deploy money repeatedly. One burns, the other cycles. And before you say, that's easy to say when you're rich, stop. This mindset doesn't start with millions. It starts when you have almost nothing. In fact, the less money you have, the more dangerous bad decisions become, because you don't have margin for error. Here's where most people destroy their future. They wait. They tell themselves, I'll start investing when I have enough money. Enough is a fantasy. Enough never arrives. Expenses expand, life happens, inflation eats, and suddenly 5 years pass with nothing to show for it. Waiting is the most expensive decision you're making. $100 is not too small. $100 is the test. It's the training ground. It's where habits are formed. If you can't turn $100 into $120, $150, or knowledge that compounds, you won't magically do it with $10,000. Scale doesn't fix broken thinking, it exposes it. The poor mindset treats money as a reward. The rich mindset treats money as a worker. That's why rich people don't ask, can I afford this? They ask, will this pay me back? Will this buy me time? Will this increase my skill set? Will this put me closer to an asset, a network, or an opportunity? If the answer is no, it's not an expense, it's a liability. And here's the part that hurts. Most people already know this, they just don't act on it. Because buying something feels productive. Investing feels uncertain. One is comfortable. The other forces responsibility. Comfort is expensive. Every year you delay learning how to deploy small amounts of money, you lock yourself into the same income level, not because the system hates you, but because the system rewards people who move early and often. This isn't about being perfect. It's about direction. Shoes go down in value. Skills, assets, equity, and ownership don't. One choice shrinks your future. The other expands it. The biggest mistake you're making right now isn't lack of money. It's waiting for permission to start. You don't need more money. You need a different relationship with the money you already touch, because $100 spent like the poor disappears. $100 deployed like the rich begins to multiply. And that single shift is the line between staying stuck and finally moving forward. Let's get one thing straight before we touch the numbers. This is not a get-rich-quick plan. This is a get-unstuck plan. This is how you stop being a spectator and start becoming a participant in the system that's already extracting value from you every single day. The goal of your first $100 in 2026 is not to flex, not to gamble, and not to feel busy. The goal is to build a foundation that compounds in 3 directions at once: stability, upside, and personal leverage. That's why this blueprint is split into 3 parts. Not because it's neat, because it works. First, a safe base. You take $40 and you put it into a broad market index fund or ETF, something boring, something diversified, something that tracks the overall market instead of trying to beat it. Funds like VIO or VTI exist for one reason: to capture long-term economic growth without you having to be a genius. This part of the plan isn't meant to excite you. It's meant to anchor you. Most beginners make the same mistake. They either go all in on risky bets or they don't invest at all. Both are emotional decisions. The safe base removes emotion. It trains you to think long term. It teaches you how markets move, how compounding feels, and how boring consistency quietly wins. This $40 is doing one job, keeping you in the game. When markets dip, this portion reminds you that downturns are normal. When markets rise, it shows you the power of participation. You're no longer watching headlines, you're inside them. That psychological shift alone is worth more than the money. And here's the part people underestimate. Index investing is not for people who don't know what they're doing. It's for people who understand that the system is designed to grow over time and want exposure without needing to predict the future. This $40 doesn't make you rich. It makes you durable. Next comes the asymmetric upside. You take $30 and you deploy it into 2026 focused technology and AI, not hype coins, not random penny stocks. Fractional shares of real companies building infrastructure for the next decade. Companies working on artificial intelligence, cloud computing, semiconductors, automation, robotics, data, energy efficiency tools that businesses and governments are already integrating, not might use someday. This is where most people either get greedy or get scared. Both are mistakes. You're not trying to hit a lottery ticket. You're trying to place small, intelligent bets on the direction of the world. AI is not a trend. It's a layer being added to everything. Healthcare, finance, logistics, education, manufacturing. That doesn't mean every AI company will win. It means the sector itself will absorb massive capital. Fractional shares exist for a reason. You don't need thousands of dollars to gain exposure to world-class companies anymore. Waiting until you can afford a full share is an outdated excuse that keeps people on the sidelines. This $30 is your growth engine. It teaches you how volatility feels. It forces you to confront fear and greed on a small scale, where mistakes are survivable. It trains your decision-making muscle. You learn to think in probabilities instead of emotions. You start asking better questions. What does this company actually do? How does it make money? Will this technology still matter in 5 years? That learning compounds harder than the dollars. And if one of these positions grows aggressively over time, it doesn't just increase your net worth, it increases your confidence. You stop seeing investing as something other people do. It becomes something you understand. Now comes the most important part. The part almost everyone skips. The part with the highest return in 2026. The final $30 goes into self-education. Not motivational garbage. Not vague get-rich content. Practical knowledge. A book that teaches a real skill. A specialized tool. A course that increases your earning ability. Something that either helps you make more money, save time, or understand systems better. This is where the biggest leverage lies. Markets go up and down. Skills compound forever. If you improve your ability to earn, analyze, communicate, build, or sell slightly, you've increased the ceiling on every future dollar you touch. That's why the best investors on the planet spend obsessively on learning. They understand something most people don't. The fastest way to grow capital is to grow the person deploying it. A $30 book that helps you increase your income by even $100 a month is not an expense, it's a machine. A tool that saves you hours every week buys you time, and time is the only non-renewable resource. Education isn't about certificates, it's about leverage. And here's the key. You don't wait until you're rich to invest in yourself. You invest in yourself so you stop being poor. This is where the mindset shift locks in. Most people treat education as something they did in the past. Rich people treat education as a recurring asset. They are constantly upgrading their thinking because they know outdated thinking is expensive. Now zoom out and look at the full picture. Your $100 is no longer sitting still. It's doing 3 jobs simultaneously. The index portion gives you stability and exposure to overall growth. The tech portion gives you upside and future alignment. The education portion increases your earning power and decision quality. That's diversification across assets, time horizons, and yourself. And notice what's missing: panic, perfection, and waiting. You're not trying to time the market. You're not trying to predict crashes. You're not trying to be right every time. You're building a system that benefits from participation. This blueprint works because it's repeatable. Next month, if you add another $100, you don't start from zero. You already have structure. You already have momentum. You already have experience. That's how people quietly build wealth while everyone else keeps planning. And let's address the excuse that's probably forming in your head right now. This won't make me rich. Not immediately. And that's the point. Wealth is not built by one decision. It's built by a series of aligned decisions that compound over time. This is decision one, the hardest one, the one that proves you're serious. Because once you deploy your first $100 intelligently, you stop being someone who talks about money and start being someone who uses it. And that changes everything. You'll start seeing opportunities differently. You'll stop wasting money on things that decay. You'll start asking better questions. You'll feel the cost of bad decisions more clearly and the reward of good ones more sharply. That awareness is dangerous in a good way. This blueprint isn't about predicting 2026. It's about positioning for it. And no matter what happens, boom, recession, volatility, you're learning, participating, and compounding. Most people never do this. They wait for perfect conditions. They wait for more money. They wait for certainty. Meanwhile, inflation waits for no one. The goal isn't to be fearless. It's to be active, because money doesn't respect intentions. It responds to action. And this is how you turn your first $100 from something fragile into something functional. Not by saving it, not by spending it, but by deploying it with purpose. Before you even think about investing another dollar in 2026, you need to know what not to buy. Because for most people, the real reason they stay broke isn't lack of income, it's silent financial leaks. Money doesn't just disappear. It gets drained by bad purchases that feel harmless in the moment and devastating over time. If you want to move forward, these are the 3 traps you avoid at all costs. First, fast fashion and hype clothes. This is the most socially accepted wealth destroyer on the planet. You spend $100 on a logo, a trend, or a drop that's hot right now. The second you walk out the door, that item loses 80 to 90% of its value. 2 years later, it's worth nothing. No resale, no utility, no return. You're trading future leverage for temporary validation. The fashion industry is built on convincing you that identity comes from consumption. It doesn't. Real wealth is quiet. And the people actually winning financially don't care what brand is on your chest. They care what's in your portfolio. If it doesn't pay you, grow you, or increase your earning power, it's not an asset, it's a costume. Second, new cars bought on debt. This is the interest trap, and it ruins more financial futures than almost anything else. A new car feels like progress. It feels adult. It feels like success. In reality, it's a rapidly depreciating liability financed with expensive money. The moment you drive it off the lot, the value drops. But the debt doesn't. Then interest compounds against you while the asset shrinks. You're paying more over time for something that's worth less every month. That's financial gravity pulling you down. A car that gets you from point A to point B is a tool. A car that locks you into years of payments is a cage. In 2026, flexibility is power. Debt on depreciating assets kills flexibility. Third, and this one is critical, get-rich-quick crypto schemes. Not all crypto is bad, but most meme coins are pure speculation with zero utility, no revenue, no real use case, no long-term plan, just hype, influencers, and the promise of easy money. That's not investing. That's exit liquidity. These projects are designed to transfer money from impatient people to insiders. They spike fast, dump faster, and leave you holding something no one wants. If you don't understand what the project actually does, how it creates value, and why it will still exist in 5 years, stay away. There is no shortcut to wealth. Every time someone promises one, they're selling you the illusion, not the outcome. 2026 will reward discipline, positioning, and patience, not trends, not flexing, not desperation plays. The rule is simple. If it makes you look rich but keeps you poor, don't buy it. Protect your capital first, because money you don't lose is money you can finally deploy. 2026 is not going to be kind to people who sit still. It's going to be brutal to the passive, expensive to the distracted, and incredibly rewarding to the ones who move early with intention. This is the year where the gap between people who understand money and people who just earn money gets wider than ever. And that's why this moment matters. You don't need permission. You don't need perfect timing. And you definitely don't need advice from billionaires who forgot what it's like to start with nothing. Their rules were built for protecting millions, not building the first 100. Yours are different, and that's okay. This is your challenge. Take your first $100 and put it to work this month, not next year, not when things settle down. Now, build the habit before you build the balance, because habits scale faster than income. Remember what we covered. You're not trying to impress anyone. You're trying to change direction. That first move is the hardest because it forces you to stop consuming and start participating. Once you cross that line, you're no longer guessing, you're learning in real time. Mistakes will happen. That's part of the process. But small mistakes with $100 are tuition. Big mistakes later are regret. The people who win long term aren't the ones who never mess up. They're the ones who start early enough to learn cheaply. 2026 is the year of the smart investor. The person who understands that money is a tool, not a trophy. The person who knows that waiting feels safe but costs the most. The person who stops asking, what can I buy? And starts asking, what can I build? That can be you if you start. So here's the deal. If you're committing to investing your first $100 this month, comment start below. Make it public. Lock it in. Accountability changes behavior. And if you want to stay ahead, if you want to understand where money is moving in 2026 before it shows up in the headlines, subscribe to the channel. We break this down every week. No hype, no fluff, just strategy. This isn't about getting rich fast. It's about getting smart early. And it starts right now.